We're going to begin now to build an investment appraisal model using discounted cash flow to enable us to be able to work out the financial value of a single tenanted real estate property. To do that, we first of all need to download a couple of files out of Moodle. The two files we need are the DCF student template spreadsheet and also its associated PowerPoint presentation, which is there. And we'll open both of those up. The student DCF templates has a number of sheets in it, and that basically works through from some background introductory material, some theory if you like. Here we have the first page, which is the introductory instructions. I recommend that you read through all of those because they give you some theory backgrounds and also help you with some practicalities of building the spreadsheet. You might need to come back to those if things don't seem to make as much sense to you as you would like as you go along. The second sheet, a very important one for understanding yields because it's what I'm calling ratio notes, and it basically goes through a series of definitions of the different yields, a text definition of them, and then also some notes as to how they're constructed, and in the basic example we're going to be using what the numbers are. And so you'll find this useful, especially after what we're covering this morning. The third sheet is the most important for our purposes. It's a self-correcting exercise which we're going to work through, and by the time we get through all of the yellow highlights, and by the way some of them haven't appeared yet, you'll have a discounted cash flow model for the appraisal of any property investment you might like to put through it, especially for single tenanted properties. But it is quite a flexible little model. So it's a useful, practical thing to take into your professional careers or even for your personal property investments. But it also then leads into understanding the more complex ones. I'm giving you an absolutely blank example of the same format, and that way you can build your own one. And I recommend that you do this rather than simply doing the self-correcting approach, because this is going to be more flexible for you and you'll be able to really make it your own. It's a good way to actually cement in, if you like, the learning from doing the exercise. Then I'm giving you a series worked examples. Now these worked examples don't have any mathematics in them, and so they're basically just the answers. And so there's a 5-year model with no tax, a 10-year model with no tax, a 5-year model at 30% tax, and so on. And lastly is an alternate layout. Now the model that we're doing is a practical layout, but it's not the only layout. One of the things I want you to be really clear with is that there's no one layout for doing a DCF, and in fact the model we're going to be working through in the self-correcting exercise is in fact not exactly the ideal layout for doing these. Not that it's a bad one, it's just that there are some places where it can be improved. I'm not going to mention where they are. I'll let you think about that as we go along, so that you may want to build a better laid out model for your own purposes as you understand the mathematics and the Excel modeling and so on that's behind it. So this is a classroom exercise. It's not too bad. It's certainly mathematically precise. However, for a couple of reasons, I think you can improve on the layout, and I'd really like to see you have a go at that when we get to the assignment. So this is what we're going to be filling in and working with. Let's go back now and look at the PowerPoint presentation, and that's what's going to occupy most of our attention from here on. Bring up the PowerPoint presentation. You should have that off the web, and we'll go straight into the exercise now. We're going to begin with a little bit of background. I've already shown you the basic template, and I recommend that you simply fill in the template going through the self-correcting exercise in the first place. But the other thing I'd like you to give some thought to is, as you build this, work through it and check it using a financial calculator. You will need your financial calculator and the skills to be able to do it for the final exam. And the best way of getting on top of the calculations you need in the final exam is to practice them from early in the course. Let's say from week 2, which is now. And so as you do this on Excel, you can't take Excel into the exam room, get out your calculator and actually check the calculations as we go through. And I'll be reminding you this from time to time. On this first slide, it's simply just an introduction to the model. I've already shown you that live if you like. You'll also notice as we go through, these are hyperlinks, these first few points here. We've really covered those in the previous video on IA methods or investment appraisal methods. Just want to point out that the data is obtained in many different ways, and this is where some familiarity with the property industry is useful. Now, for those of you who may not have a property background or maybe doing this course as an elective, you might say, oh, that counts me out. Well, it really doesn't, because while we're looking at residential property investment, which is what we're doing here, that's very accessible to most people in the community. And as I've mentioned before, go along to the local real estate agent, look in the window, and you probably get a big slice of the information that you need anyway. However, the closer you are to understanding the way that looking after houses works, the better off you'll be. But the data comes from different sources. Most of them will come from your real estate agent, from an understanding of construction costs and maybe maintenance costs, and looking at finance costs. So for those of you who are doing this as part of a finance degree or an accounting degree or something, will find that you'll understand the finance data probably better than the property people, and property people vice versa with the property data. All of you need to understand all of it, and it's really quite accessible. The data can come as money amounts. In fact, most of the data is. It can come as percentages, especially things like the discount rate, the inflation rate, market growth rate, things like that. And there are some other numbers in there as well, the odd ratio here and there and things like that. I'm going to start by just giving you some general model writing tips. Now you can read through this slide as fast as I can read it to you, so I'll let you do that. One of the things that I will be doing, for instance, is using blue color for the data. That's the place where you actually put in numbers that are going to drive the model, and black numbers for the answers and the equations. I'm also suggesting that you separate the model into different areas. So one area where you put in all of your data, another area which I often refer to as the engine room part, where you do your computations, and then a third area at least for your results. And then later on we're going to be talking about uncertainty testing as well, but that's getting a fair way in front. But just in terms of model layout, in really complex models you'll find they'll be on different sheets. This model will all fit on one sheet, and in fact the first 3 elements in the model will all fit so that they can comfortably be printed on a single A4 page. The uncertainty testing does take up a bit more space. I'll be demonstrating how to use the absolutes as we go along. I'm recommending to you that you only use one place where you enter each piece of data, but never write data into equations hardwired, hidden within cells. So I prefer not to see something that looks like C4 times 0.07, where 0.07 is something, management fees or inflation rate or something. Okay, it's good to have a cell for the inflation rate or the management fees, whatever, and your equations should all read something like C14 times B12 or something. Okay, that way you don't accidentally lock your model into being stuck with fixed data. Very common problem. We've all done it at some point, especially students, but it causes a lot of problems because sometimes your model will work with some sets of data, but then when the data changes, suddenly it's not working very well. Very dangerous. Okay, I'm also suggesting you spend a bit of time on formatting, highlighting, boundaries or borders, sorry, and that sort of thing. And the more practice you get with writing Excel, the faster and more confident you'll be. So they're just some general tips. Now we move on to the operating cash flow. Operations means a regular business activity. That's a year by year. Now, for an investment property, that means the regular collection of rents, the regular payment of costs, and other cash inflows and outflows that happen. You can think of this, for those of you with an accounting background, as something like a profit and loss statement. It's really a cash flow statement, so it's the dollars that are coming into your pocket, going out of your pocket. Down the right-hand side, I'm showing you a data set which we're going to be using for this model. Now, the numbers in this don't necessarily relate to any particular property, and so in your location, properties might sell for a lot more or a lot less. This could be a home unit on the outer edge of a city somewhere, or it could be some other piece of property which is able to earn a rent. The important thing is that it gives us an idea of the relativities and the kind of headings that we're likely to come across. The numbers are cash flow items, so they don't include accruals, promises, obligations, prepayments, anything like that. It's the actual cash that is paid or the cash that is received. Okay, let's look at the kind of numbers that we're going to be working with. First of all, we're assuming a cost, that's the number of dollars that the property is acquired for, in this case of $270,000. At the beginning, we're not going to be worrying about tax, and so we'll leave it as a tax rate of 0, but eventually we'll be putting in a tax rate here. Leverage, because we're doing financial investment appraisal, we're going to look at a leveraged model. Obviously, if you don't want to put leverage and tax into your model, you simply put 0 in for the leverage rate and 0 for the tax and so on, and that's not a problem. But by putting leverage in and taxation, we're going to be coping with, or having a model that will cope with, the more complex situations. Our model is only going to run for 5 years. Now, most DCFs run for 10 or more. The reason we're doing 5 is simply because it's easier to do on screen so that we can see what's happening on one page. If we did a 20-year model, we would find that it's just visually harder to work with. However, I'm going to be asking you to build your model for a lot bigger than 5 years, and you'll find that once you build a model that's more than about 3 years, it doesn't really matter whether it's 3 or 30 or 300 years long, it's just a matter of filling numbers across or equations across. However, for our purposes, we're going to be using 5, but don't think that 5 is the gospel must-do period for investment appraisal. We've got some depreciable inclusions here. That's actually not going to be an issue in our initial model, simply because without tax, depreciation isn't going to come into the model at all. So we don't worry about that, but these are going to be numbers where we're looking at the taxation, which will be in a few weeks' time. This is the circumstances for buying the property, so it's just got to do with what I'm going to call the capital acquisition. The year-by-year operations of this investment property are down in this panel down here. And so we're going to have our income items. The first income item is the rent. That's the most important one. So we're going to say there's $25,000 per year coming in. The next one, this is simply a secondary income item. Obviously, not a lot of houses get signage income. It's something that often happens with commercial buildings. You have an office tower, and on top of it, it might have some large company's name on it. A large company doesn't actually own the building. They simply have the right to put their name out on top of it. Often in CBD areas, a large tenant might occupy a large part of a building, and so they'll put their name on it, even though they neither own the property or occupy all of it. So signage is an important element. We're just putting it in here as an example of some other form of income. It could be income from having a mobile phone tower attached to your building. And there are many other forms of miscellaneous income, if you like. In this section, if you wanted, you could have rent from tenant number 1, rent from tenant number 2, rent from tenant number 3, simply by adding a few rows. We're not going to worry about that because we're using a simple model here. I think you can see that by adding a few rows and having more than one rent item, eventually that's extremely easy to put in. We're just leaving it out for simplicity, but you could put it in without causing too much bother. The next item we're going to put in here in the income area is an allowance for vacancy. Now this is what accountants refer to as a contra entry. Contra means that it's an accounting entry which goes backwards. In this case it's a negative amount. Now there's very few places in these models where we'll put minus signs, simply for the practical human reason that human beings make mistakes when they're using negative signs. And so we minimize the use of negative numbers wherever possible. However, there will be a few of them in our model from time to time. Most of the time we get around the negative numbers by simply recognizing that something is going to be subtracted, and we subtract it, but we actually put the number in positively. That's most evident when we get down to the expenses. Now the expenses are all being subtracted from the incomes, but you'll notice we don't put negative signs in for the management items. In the same way, you accountants know that when you have cost items, they don't go in as negatives either, they simply go in on the opposite side of the ledger. Okay, the expenses are pretty much typical major categories that you'll find in small investments, or in fact large investments. Again, you can add extra rows to put in more detail, and if you eventually want to build up your model so you can use it for a multi-tenanted building, you could make even more distinctions in here and so on. The major ones are management. Management refers to the money that the investor pays a property manager to collect the rent, basically. Often it will be expressed as a percentage of the rent itself. So in the old days it used to be about 7% of rent. Now it's a little bit more negotiable. So while we're putting in here as a dollar amount, it could also be entered as 5%, 7% or what have you of the rent. So 5% would be reasonable as your data for management, simply because that's how you understand it. If the rent goes up, so does the management. Here we're putting it in as a dollar amount. Likewise, insurance, there's a number of insurances, but for the building itself, that will be something that the owner will have to pay for. Again, another dollar amount. Insurance tends to follow the value of the building, and so it will tend to grow following the growth in rents, the growth in property values. The growth in property values is probably closest, because usually you insure a property on the basis of its replacement value. Next item here we're putting here for our example is the maintenance costs. Now this is going to be an estimate of how much you're going to spend on fixing the roof, painting the walls, whatever you're going to be expecting to do as part of your normal maintenance. Later on we're going to distinguish between maintenance, which is fixing the roof, and capital investment or capital expenditure, which would be maybe putting a new roof on. Maintenance doesn't depreciate, so for instance if you paint the house, it's simply an expense, and so you're able to take a tax deduction on it immediately, whereas capital expenditure like replacing the kitchen or the carpets or something might be depreciated over a period of years, and so it's treated for taxation purposes quite differently. However, for our purposes, if you find yourself buying a nice little investment property, maybe a home unit or what have you, as your superannuation, you'll have to estimate how much maintenance you're going to be expecting to spend each year, and the more experience you have, obviously, the more precise that number will be. The last item we're going to consider for expenses are rates and taxes. This is things like local government rates, property, perhaps land tax to the state government. There might be other rates and taxes that you may have to pay, water rates and things like that, if you can't transfer it onto the tenant. Again, these are the major categories. It's good to be aware of what they are, also to have a bit of a feel for how big they should be, and also their rates of growth eventually. I'm not going to worry about that now. But this gives us a bit of a picture of a typical kind of small residential property investment. What we're going to be assuming is that these estimates are all estimates for the numbers that we're expecting to have to either earn or pay over the first 12 months. So the first part of our model will be to consider that these estimates are here for the cash that's going to flow into our pockets or out of our pockets in year one. So here's year one happening. We're going to be looking further at the model as we go along. Okay, now you can enter these names and this data into the left-hand spaces on your data sheet, and we'll give a demonstration how to do that. In fact, we might do that now. Here I have the student templates model out, and I've got it set at the self-correcting page. What I'm going to do is just shift it across so I can look at my PowerPoint numbers, and I can start to transfer some of this data across. I can write in these numbers, so I'm going to write costs, and I'll write it exactly the same as it is there, and you'll notice my yellow highlight has disappeared. I'll come over and put the value in, 270,000. Now there aren't yellow highlights for the data. Don't worry about the reason for that, and I'll just copy in the rest of these labels. Here I've simply done a lot more typing, so rather than having you watch me go through and put all of these numbers in one by one, I've simply given myself a little bit of time to myself to get all that stuff going. Now you'll notice down here in the operations area, I've put in the data and also the headings. I've got time naught, which is the time when we buy the property, and we've got time 1, which is the end of the first year of operations. And what I'm going to do here, I've actually brought in the numbers, but I want to put those as equations. So I'm going to go equals that, and I'm going to carry on and do little equations here. So I'm building little equations. Once I get this first one, by the way, I can simply come down and do all of those as equations. This one's actually not supposed to be filled down because it's the vacancy allowance, vacancy of 2% of the rent. So we're going to work that out as an equation, going to equal 25,000 multiplied by 2%. That signage is not considered to be something to consider for vacancy. This number here really should be the sum of those things above. Now I can write that out as a series of additions, or I can use the sum function in Excel, which is a nice way of doing it. It comes in yonder. That number there, by the way, should be a minus sign from what we were talking about before, and we get 25,020, which is the same number that we have in the presentation. Down here, I'll just take these out and I'll calculate them by hand again. Again, these are going to simply equal from there. And so the first year operations is my estimates brought into the first year. I'm just going to fill this down by grabbing the lower right hand corner of the cell, click on the mouse, drag down. So that brings those down nicely. Again, I'm going to use the sum function. Excel has the sum function as a menu item up here. Now because this model has protection on it, mainly to protect the hidden cleverness that gives the self-correcting highlights and so on, we can't use some of these functions, so I'll have to write this longhand. But when you're building your own models, you won't have that limitation, which is one of the advantages of writing your own model nice and early. You can use these other functions. Here, we'll again just write it in longhand, sum, open brackets, and then this list of possibilities, close brackets, return. Again, that gives us the same number as in the PowerPoint. Okay, so what we've got is all of these revenues coming in. We've got the vacancy allowance and so on, giving us $25,020 for the year. We've got the expenses going out, giving us about $5,290 in expenses. So what's our earnings before interest and taxes? It's simply the revenues minus the expenses. That gives us that nice number. That's our net operating income. We now need to work out the interest cost. To do that, we're going to have to work out the parameters of the loan. Let's come back up here and we can see that we're saying that we're going to be borrowing 80% of the value of the property, 80% of the $270,000. And so we can work out the loan from that. The other thing we need is an interest rate. Now I'll just move this model into full view here. You'll notice that over here we've got a cell already marked in which is asking us to enter in the loan amount. The loan amount we will work out with a little equation is going to be the value of the property multiplied by the leverage amount, which in this case is $216,000. We now need to put in some rates. That goes into this area in our class model. May not be the best place, but it's the way the class model is laid out. There are a number of rates that we need to consider for even a simple property investment DCF. To give you an idea of the ones in this case, probably the easiest way is to cheat a little bit, and we'll just duck ahead to look at the example of the 5-year model without tax. We come up here, you'll see here's the model laid out for us. We've got a series of rates here, which is all of these numbers here. For simplicity, we'll just copy those in because they're data. I'll bring in the titles, and then I'll bring in the values. I'll paste those. Let's come back, and just for completion, we'll bring in the purchase fee allowance and the sale fee allowance. We'll be talking about those later on, but it just basically tidies up the model, gets our data all in place. Okay, so now we have all of these rates. The CPI is the inflation rate. CPI technically, by the way, is a number, it's not a rate. But most of us use the term loosely, so rather than writing inflation, I'll simply use CPI. This is the annual rate of change in value of that basket of goods, which we use for the CPI, Consumer Price Index. Loan interest rate is the one that's going to really appeal to us, or be important to us at the moment. And so to look at the amount of interest we're going to be paying, in the loan we're considering, by the way, for financial purposes, the best loans are not the kind of loans that the average person gets for their home mortgage. That loan is one which has repayments which are made up of some principal and some interest. For optimum financial performance, it's better to have an interest-only loan. What that means is that year by year, you only pay the interest cost every year, which means that the loan amount, the principal outstanding, remains fixed, in this case at $216,000. We're now able to work out the annual interest amount, which we're going to put in down here in cell E27. And that's simply going to equal the loan amount. And we said it's an interest-only loan, so we multiply that by the annual interest rate, and that will give us the annual amount of interest. Okay, at this point, we basically have the data, if you like, for the property investment laid out in our DCF analysis model. That's the capital acquisition situation, how much it cost, what gearing we use, and so on. We've got our rates that we're going to be using mainly for working out what happens into the future, but also especially the interest rates. We've worked out, as we've seen, the loan amount. We don't really need to put that in a box, but it's kind of handy to lay it out. Then you've got the other data, which is our operating data. That basically gives us a picture of what's going on. From here we can work out how much money we're earning after everything is settled each year. So here we've got the earnings before interest and taxes minus the interest cost. And that means that year by year we've got about 4,600 coming out of this particular investment. That's good. That's a static snapshot, if you like, of the situation that's expressed as what's going to happen in the first year of operations. Let's go back now and look at our slideshow. Here we've said we've got our operations all laid out, and you'll notice that down the bottom of this slide is inserted the loan situation, and also the purchase fees are laid out. Let's go to our next slide. In this slide we're going to calculate a number of ratios. These are the static measures of performance. We're going to be working out a number of these different yields. The yields are all defined in the first sheet, and so we'll go through now and calculate those out. I'll let you read through the points on this page. They basically give you the background and how to do it. We won't worry about reading them, we'll just demonstrate it by doing them in the flesh here. Let's go back to our model. Before we leave the model completely to work out our ratios, we need to calculate a couple of other bits and pieces. I'm going to be putting in a few headings down here. In fact, I'm going to again borrow the headings from the completed model. So I'll just take those headings down the left hand side here. Easy to do it now rather than wait until later. They go in. Now the first thing I want to look at is what happens in time naught. Time naught is the time, the moment in time when I acquire the property. And what's going to happen here? What cash is going to be coming in? Well, one of the curious things is that even though the property is costing me $270,000, I don't actually have to spend that much cash. Let's look at how it goes. I've got the purchase price, which is $270,000, but then I don't have to pay all that because the bank is going to pay some of it for me. Let me just move this model over a bit. It's going to pay $216,000, and so that means that I'm only out of pocket by $54,000. However, I also have to pay certain fees to acquire the property, largely legal fees for purchase. For sale, that will also include real estate agent fees in most cases. Let's look at the purchase fees. We're assuming here that the purchase fees are going to be an allowance of 2% of the purchase price. Let's calculate what they are. We've got an equation here to build. That's going to be the purchase cost multiplied by the allowance for purchase fees, which is $5,400. Not sure why that's coming up as a blue font, but that shouldn't be. I would like to put that number down here, so it simply equals, down here it's another highlight gone. Let's look at what's happened in the first 12 months of running this property investment. I have bought the property for $270,000, also taken a loan, which means I've only actually paid out $54,000 of my own money. I've also paid out $5,400 in purchase fees, which means that my total costs to purchase the property equal, now this is, the $54,000 is going out of my pocket, so I'll put it as a negative value. And as well as that, there's another negative value, so another subtraction of the $5,400 gives me minus $59,400. Now I said earlier that we're not going to use negative signs wherever we can avoid them. However, along this row along here, we're going to use negative signs simply because in this row, which is our total cash flow row, total after-tax cash flow eventually. Some of these are going to be negative, some of them are going to be positive, and because we don't know whether negatives and positives are going to be, we simply have to put the signs in. Whereas we always know that the leverage purchase price is going to be an outflow, so because it's always negative, we don't need to put the negative in, we simply use subtraction when we do our calculation. To make this equation also a little bit more general, we're going to add to this number any potential operating income for this year. So I'm going to put plus and then the before tax cash flow up there as well. We're going to be adding to this equation as we go along, by the way. Why did I write the equation like this even though there's nothing in this row? It's so that I can fill this one equation across, and now it's bringing down the 4,610, which is the operations for year one. It's kind of got a hidden in it provision for further perhaps purchase or what have you, or other fees that I don't happen to be using here. So it's not nice for that equation to be able to use those cells if I don't need to. Ultimately, what I'm going to be doing is building up this equation so that it copes with a number of these items here that are mainly used for taxation, but also for the final sale event. Okay, what have I got? I have my total acquisition cost, and I've got my first year's net operating cash flow. Now I can work out some of these ratios that we were talking about. The ratio section is down here in our model. In this section, again, what I'm going to do is steal, copy forward from the worked example, at least the headings. That gives us a little bit of a head start. It also tells us what ratios I want to be putting in here. You notice I put the right headings in, so the yellow highlights have disappeared. Let's work through now and look at these different yields. First of all, the gross yield is probably the simplest one. That's simply the apparent income. That's the, in this case, a little tiny bit more complicated than simple rent because there's two items of income, because we have the extra line of income through the signage. And so basically the total income, or rent, total rent, apparent rent, divided by the value of the property. So that gives us 9.45%, and we've got the yellow highlight to go away. When it comes to the net yield takes into account your expenses. Now there are a number of different net yields, and this is one of the complications with working with yields. Different people calculate them in different ways, add or ignore different elements and also different purposes. In our case, there's a slight difference between net yield for the way the valuers look at it, which tends to ignore vacancy, whereas net yield, if you're looking more from an investment appraisal perspective, you'll consider vacancy because you're interested in a realistic estimate of what your incomes and expenses are. So here we're going to take the revenues, the total revenues, so that's including all of the revenues and the vacancy allowance, and from that we're going to subtract all of the expenses, and then we're going to divide that net income, that net operating income, by the value of the property, and that gives us 7.31%. The next yield to look at is the leverage yield. Now this takes account of the fact that we're using debt. When we're using debt, our net income, our net cash flow, is the cash flow after interest. And so in this case, it's the 4,610. We divide that not by the total value of the property, because that's before we apply debt funding to it, but how much cash we actually spend. We find that in cell D33. We do that division, and that's 8.54%. it's a good idea for you to look at the way these numbers are trending. We start off with a high gross yield, well, a number. The net yield is lower than the gross yield because we're taking account of the action of your expenses. The leverage yield, even though the expenses are higher because now you've got the interest cost, also the base you're dividing by is lower because you're no longer dividing by the whole purchase price, but merely the amount of cash that we had to put towards buying the property. And because of the workings of leverage, our net yield has actually improved as a result of leverage, and that's what we expect. And so we go from 9 down to 7, back up to 8. We don't have taxation in our model yet, but the important thing about taxation, if we were to consider it, is that we'd be considering after we consider the effect of tax. Now, for property, this can be a bit complex because on various occasions, tax can actually end up being the equivalent of cash flowing into our pockets. We'll be dealing with that another time. However, we'll complete the calculation. We're going to use, in this case, and I'll start the equation, the total after-tax cash flow as the net operating income amount that we're going to be using here for this yield. We're going to divide that. I'll have to use a negative sign here to keep the conventions working properly. We're going to divide that by the net acquisition cost, and we're going to include here the purchase fees, because this is looking at the financial investment as it really is, taking into account every element that's got to do with the capital acquisition, which certainly includes the purchase fees. Couldn't buy the property without spending money in that regard, and also every element available in the operations. So we'll divide by D36, and that gives us 7.76%. And so we can see that the after-tax yield is a little bit lower than the leveraged yield. In certain circumstances, the after-tax yield can actually be better than the leverage yield, and that little bit of magic we'll keep for another time. When we get down to interest coverage is more of a financial ratio than a property ratio, but I'm including it here for completeness. The idea of interest coverage is that it's how comfortable the bank is with earning their interest or receiving their interest out of the project, out of the investment, compared to the earnings which is available to pay things like interest and dividends. In this case, we've got earnings before interest and taxes of $19,730, and we've got an interest cost of $15,000, so we simply divide the 19,000 by the 15,000. Let's look at doing that. The usefulness of the interest coverage ratio is that it gives us an idea of how comfortable the investor is in being able to pay their bank obligations. And the bank's probably going to be more interested in that than the investor, but it's still important. If the debt coverage ratio, the interest coverage ratio, isn't strong enough, if it's, let's say, 1.01 or something, it means that circumstances only have to change a little bit and the investor won't be able to pay the bank, and that would look a bit embarrassing. The last ratio we'll look at is the price earnings ratio, and the price earnings ratio can be thought of quite simply as the inverse of the net yield. Different people calculate it as the inverse of different quantities. For instance, it could be the inverse of the after-tax yield as well. Again, it's a matter of looking at the context and looking at what the person giving you the number means by it. So it's always important with these ratios to check what's actually in them. In our case, we'll simply take 1 over the net yield, and that gives us a price earnings ratio of 13.7. Now, for those of you who remember the previous video, you'll remember that the price earnings ratio is a bit like a year's purchase in some respects. It's a income multiplier. I think that covers about as much as we need to go through for this module. Obviously, we've got a lot of yellow boxes still to go, and so as time goes on, we'll be filling out more of our model, but we'll leave that for another time.